just probability of default, right? Means the next 12 months, not this month, the next 12 months, what is the chance of this bond or this company will go into default? What is the chances? Yeah. So we can use this table to do that. Okay. Now, how to do that? Right. Basically, you can use what we call something like the decision tree methods. Yeah. What do you mean by decision tree methods? Right. Now, I won't show you the long approach. Yeah. But I just briefly show you some example. Right. So let's say currently the rating is A, right? Rating is A. So within the 12 months, right? So if you go to AAA, right? Okay, within 12 months, right? The chance of going to AAA is 0.06, right? Means it can go up from here, go up to here is 0.06, then go up to AA is 2.72, right? So if I were to put it 0.06, 2.72, right? But it can also go into default. Default is 0.02, right? Right? 0.02. Right? 0.02 default, right? You can go into default. Okay? Right. So I won't fill up the rest. Because I just want to show you, right? Okay, so this is what happened. Now, this is for year 1. Okay? For year 1. Okay? For year 1. Okay? Year 1. Right? Now, once it's defaulted, it's end of story. Cannot proceed anymore. If this loan is defaulted, you cannot proceed anymore, right? But if it's not defaulted, then it can move on to the next year, right? Means if this next 12 month not default, then it will survive and move on to the next year, right? But if it's default within these 12 months, habis. Tutup kedai, end of story. So if it's not, then it can move to year 2, right? Year 2. Okay. Now, if we are interested in finding what is the probability of default for year 2, right? And then we can say that, okay, what happened is this. Now, if next year, let's say if next year, right? If next year the company survive, one of the possibilities is they will move upwards, right? From 87.756%, it will upgrade to AAA 0.06. Yeah. So means next year there's a chance that they will be in AAA rating, right? Next year AAA rating. Yeah. But if they're at AAA rating, then what happened? At AAA rating, then for them to go into default is 0.0%, right? So in that case, next year is 0.0%. Okay. But if I were to upgrade to AA, there is 2.72% chance this year. But when come to next year, if I'm at the AA, 2.72% chance, right? Then the chance of default will be 0.01, right? Okay, so it will be multiplied by 0.01, right? Okay, and so on. We can keep on doing it. Then what happens is we take this 0.06 times 0 is 0, right? Okay, and 2.72 times 0.01, it will be 0.0272, something like that. So you can keep on all of this like single A, triple B, and so on, right? Then we add this up. When you add this up, this will be the PD for year 2. Right? Now this is a long process. Yeah? You can do this if you want to. You can finish off this table if you want to. Okay? But what I would suggest to you in the exam is take the shorter cut. Just like I show you. If you go up, in this case you go up, you multiply by the default rate here. Second level, multiply by the second default. This one you set. So you look at the next slide. This is what I do, the arrow. So if you are smart enough, you know how to read this table. Very easy. No need to go and do this long way, multiply this one by one. You just go straight to here, right? I say, okay, first line, I move A, I move up to the highest rating. The default is 0.6 times 0, right? Means 0.6 times 0. Now, next level, 272, multiply 0.01. Third one, 87.56 times 0.02, and so on. Keep on going down here. Then after that, I add them up together. You just like here, you add them up, all together, add plus, right? In this case, all plus, right? Plus, all plus. Then the total will become the PD for year 2. So using this year 1 table, then we can predict or we can estimate the PD for year 2, right? So what we can say is based on our computation here, or based on table we see here, how do we interpret this? We interpret by saying that from now until the next end of the 12 months, with the next 12 months, the chances of default for a single A bond is 0.02%. Okay? And the chances of default for this A bond for the next 12 months will be 0.04%. Okay? Right? So means this year is 0.02, next year is 0.04% chance of default. Yeah? So in short, we can say that we can use this year's table to estimate next year's probability of default. We can do that. Okay? Right? And if you were to ask a question, then what is the cumulative PD for the 2 years? Cumulative, combined cumulative for this year and next year? Answer is very simple. You just take this year is 0.02, next year is 0.04, then in total be 0.06. Right? That's it. That's called the cumulative for 2 years. Okay? Right? Now, if you want to do the 3rd year, also can. But if you do 3rd year, you must have this table for the 2nd year. Then you can do 3rd year. Then you want the 4th year, you must have the table for the 3rd year. So to create the table for the 2nd year and 3rd year, you have to use matrices. This is where the complication comes in. Right? So in exam, you are not worried about that because at most they will ask you to calculate up to 2 years. Means using this 1st year table to estimate the 2nd year's probability of default. Okay? And at most they will say what is the combined or cumulative PD for year 1 and year 2. Now this is a very common thing in the examination. Yeah? Alright? Okay, so what I'd like you to do now is I want you to do it now. In exam, the good thing is they're not going to give you so many level of rating. If they want you to do this calculation, they won't give you so many level of rating. Probably they give you a very short one because they just want to test that you know, you understand this concept, right? So in exam, it's mostly something like this. 3 level of rating. That's it, right? Okay, so I want you to try this out. Try this quiz. Okay? Now, what is this quiz all about? Same thing like this. Okay? Where I say, what is the 2 years cumulative PD for a B credit rating, right? Given the transition metric table. Means they want you to work on this, right? This, right? So, just like what I explained to you, they want you to work on the cumulative PD for 2 years. Yeah, right? So, can you do it? Right? I want you to try it out, okay, using the same method that I showed you. Yeah? So, I give you few minutes to do that, and then you tell me what is the answer, A, B, C, or D. Yeah, okay. So I let you handle it, and I'll take a short break. You do it, I'll take a short break. I'll come back in a couple of minutes. Yeah. So go ahead, try it out. Hi, I'm back. Anyone got it? Cheers. Anyone got it? Just put it on the chat. Tell me what you think. C. Thank you, Shofen. Well done. Yeah, it's C, yeah? Right, it's C. And how does Shofen get C? Right, that's what she does. This is a B credit. She take this, multiply by this, multiply by this, and this multiply by this, right? Okay, so you have 0.03, right? Multiplied by 0.00 plus 0.9 times 0.02 plus 0.05 times 0.14, right? And that will take you to 0.025. Okay? Now, this 0.025 is year 2. Okay? Because what they say is they want you to have 2 period cumulative, means combined, year 1 and year 2. So we know this is year 1, right? So year 1 is 0.2 plus 0.025, which is equal to 0.045. You translate into percentage times 100 is 4.5%. Yeah? Okay? Thank you, Shifan. Well done. So if you have a question like this in exam, very easy. Yeah? But just make sure you read carefully whether they want the second year only or they want the cumulative. Right? Okay? So just be careful. Right? So some of you got this, but forget to add on to the first year because you thought year 2. But here is a cumulative. So read the question carefully whether they want the cumulative number or they just want year 2 number or year 1. Alright? Well done. Thank you, Shufan. Yeah. Okay, so that is the second table you need to be aware of on this actual approach, external rating method. And the last table that we need to cover here is what we call the average corporate default rate matrix, right? Or we can also call it average cumulative default rate matrix, right? So what is this table tells you? Now this table basically is to tell you that if you are giving this loan, right, or lending money, right, then the chances of default of this loan after 1 year is this, right? Or if you give the loan for 2 years, the chances of default is this. If you give let's say for example, you give a loan, right? Let's say you give a loan for a 2-year period, 2 years. A 2-year loan. And the loan is rated A rated. So what is the chances of default of this loan over these 2 years? So the 2 years A will be this, right? 0.237%, right? It's from the year 0 to the year 2, right? Okay, that's what you need over the period. That's what it does. If you are giving a loan for 5 years, then what is the chance of the default? Then 5 years will be 2 until here, right? And the 5 years A will be 1.116% chance of default. Okay, so this is the default over the 5 years. They are not saying 1 year. They are saying it's not every 1 year is 1.6. No, it's throughout the 5-year period is 1.16. Then what is the 1 year one? We don't know. They are only telling us for the whole 5 period. They are not talking about 1 year, 2 years. They are talking about the whole 5-year period. So we cannot identify what is the 1 year default rate in the 5 year. But we know that over the 5 is 1.116. Yeah. So the default. So another way to look at it, if this is the default 1.16, this is the default rate. Opposite of default rate is what? Survival rate. Means you don't default, you survive. Right? You survive. So what is survival rate? So survival rate is equal to 1 minus default rate lah. As simple as that. Just like LGD lah, isn't it? Okay? So if the default rate is 1.116%, then 100% minus 1.116%, then the survival rate will be 98 point something percent lah. As simple as that. Right? 98 something, right? You do the calculation for it. Right? That's called survival rate. Okay? So this is how this table is being interpreted. Now, we are not looking at 1 year default rate. We are looking at over the period of certain one. It can be over the period of 1 year, 2 years, 3 years, 4 years, 5 years. I'll explain to you more on that. Okay? But just understand this table first. Yeah? Okay? Right? So, answer some questions to make you understand it better. Yeah? Okay, look at this. The average corporate default rate table, right? Look at table 2.10. This is table 2.10. Refer to the bond rated A. Yeah, you are looking at this. Okay? The question. Calculate the following. So they want you to calculate. The probability of default, the probability that the bond will default during the period from year 3 to year 4. During the period from year 3. What they mean? It means that, okay, what is the chances of the bond defaulting from this range to this range? Okay, the answer is very simple. Take the higher one minus the lower one. That's it. Take the higher one minus the lower one. Okay, 8.08 minus 0.5. That's it. 8.8. I mean, I round it up to two numbers. 0.81 minus 0, so it's 0.331. Simple. During the period. Means you are looking at from this period to this period. So take the higher one minus the lower one. Okay? Right? Simple. The next question. What is the chances of a A-rated bond, A-rated will survive at the end of the third year? Means if you keep the bond or the loan for up to here, right, for 3 years, right? Out of 3 years, the default rate is 0. Since the default rate is 50, then what is the survival rate? Which is 1 minus default rate. So it's equal to 1 minus 0.5%, which is this. You get 99.50. Okay? So that is also a possibility that they will challenge you in the exam. Yeah? Simple. Right? Okay. Any question here? Yeah. Now, the next thing is the confusion part comes in. Right? The confusion part comes in. What's the confusion part? Okay. The confusion part is here. Right? Say that this is in order to understand how probability of default and default rate is calculated from the average corporate default rate. This is important to understand the following important terms: default intensity hazard rate, cumulative default rate, marginal default rate. Then they did it, and then give the illustration. This is the example that we did just now, right? And then after that, finish. No more. So, what exactly is cumulative default rate? What exactly is marginal default rate? What exactly is default intensity and hazard rate? What are they? This is where the book didn't explain. And for people who are not in the credit risk and never deal with this before, have no clue what they're talking about. Okay? And the thing about this is, it's quite common. They ask you questions in the exam. Alright? Okay? So, what I like to do is to just share with you. Default intensity or hazard rate. It is the same as it's the same. Right? It is the same. Okay. Now, if you look at the definition of this, I plucked this from the book. So you look at default intensity. What is default intensity? Probability of default per year conditional upon no earlier default. What it means is the rate of default if the bond or loan has not default previously. Of course, if it default, already defaulted. What is that to look at the next year, right? Right? So it definitely will be next year, year after next, if the bond has not been defaulted or the loan is not defaulted. Right? So that on the condition. So it is probability of default per year. Means 1 year's probability of default. Right? Marginal default rate. 1 year probability of default. Are they the same? They just terbalik the way they explain. So what it means is, in short, marginal default rate, default intensity, or hazard rate, all of them refer to the same thing called the PD per year, the probability of default per year. They are the same, right? They are the same. Okay. So what it means is that when we talk about the chances of default, 1 year default 2%, 2 year default 3%, something like that, right? That is called the probability of default. And basically, for most people like us, we don't say marginal default rate. We don't use default intensity. We don't use hazard rate. We just say default rate per year. So default rate per year means the marginal default rate. That is the default intensity or the hazard rate. As simple as that. Okay? Right? Okay? So, what it means is, this is called the probability of default per year. Right? Per year. Okay? Right? So, if this is PD per year, right? Let's say this is year 1, year 2, year 3. Okay? Right? If we say PD per year, means let's say this year's PD is 2%. Let's say next year is 3%. Year 3 is 5%. Right? So what does it mean? It means that the loan in year 1, the chance of it defaulting is 2%. Okay? But if it doesn't default, then it goes to next year. Means it extends to next year. So it comes to next year, then in the next year, the PD is 3%. Means the chances of it defaulting next year is 3%. Okay? But if it still not default, still survive, then you move to the third year. And then the third year, if it survive there, then the chances of default will increase to 5%. That year, in year 3. Right? So in year 1 is 2%, in year 2 is 3%, in year 3 is 5%. That's what we call PD. Right? And most of us in practice, when we talk about PD, means it refers to default intensity or marginal default rate. And they are all the same thing. Right? Okay? They are all the same thing. Okay? Then next one is cumulative PD. What's cumulative PD? This is what cumulative PD we are talking about. The cumulative PD, which is this table. This table is the cumulative PD. Right? This table is cumulative PD. Okay? Now, so how did they come to these numbers? How did they come to these numbers? How did they arrive at these numbers? Okay? This is how it works. Okay? So when you say cumulative PD means, what is the cumulative PD for year 1? Very simple. 2%. Same one. You start off at the same point. I mean, 1 year means 1 year. Right? Then next year you should supposed to be cumulative, right? Combine year 1 and year 2. Right? Combine. So year 1 plus year 2. Then this one, year 1 plus year 2 plus year 3. Simple as that. So is it 5? Why is 5? 2 plus 3 is 5. How about here? Is it 8? Is it? The question? Yeah, the answer is no. Right? We don't calculate that way. It's still like around, the concept is still add on, but we don't calculate that way. Why? Because there is an element of, we call that compounding, right? Element of compounding. So you just cannot add 2 plus 3 equal to 5, right? Or then 2 plus 3 plus 5 plus 3 plus 5 equal to, sorry, right, it's 10, sorry, 10, not 8, 10, right? You don't do that, right? So this cumulative table is not derived in this way, right? So how does it be derived? Okay, now let me just show you. This is where the book didn't explain, but the problem is in exam they do ask you to calculate. Yeah, that's where I think Chu Chong asked me about question 7. Yeah, I will show you question 7. Okay, right? So, but let's take this example first. Just look at the example. Let's do example. The one that I have. Okay. So this is the example. Now this is what I add on to you, right? Now you see this cumulative default, right? The B rated table, where I get this yellow color one, I get this from here. The B rated, the B rated, this column. I get it from here. Right? So I move this to here. This column. Right? And then this is the margin default rate. So the first year is the same, right? See, first year is the same, right? Now, remember I told you just now? How about the second year? Do you just take this plus this equal to 5? Do you do that? No. You try. You take 0.57 plus 3.45. See what you get. See whether you get 0.850. You try. Which I don't think so, right? You'll get 0.852. Am I right? Thanks, Norana. Thank you. Right? Why not 8.50? Why not 852? Why is 850? How come the table gave us 850? So this is where you need to know how to do the right computation, right? Now, to get the year, so the year 1 is always the same. The PD and the cumulative PD is always the same in year 1. But in year 2, there will be a growth, right? But the growth is not just add-on growth, it's like a compounding growth, right? So in order to calculate the year 2, you need to do this. You need to take 1, right, for year 2, right? Year 2, cumulative PD, right? To do the CPD for year 2, this is what you do, right? Sorry, to be for year 2 is equal to 1 minus survival rate of year 1 multiplied by survival rate of year 2. Okay, right? So what does it mean by that? So what is this year 1 and year 2? What's survival rate? So let's try to see. Okay, so what is survival rate of year 1? What's survival rate year 1? Now we have calculated survival rate of year 1, right? Earlier. Survival rate of year 1 is 99.5, right? 99.5. So SR for year 1 is 99.50. How about SR2? Can somebody do it for me? Take 100% minus 0.345. Can somebody do that for me? Take 100 minus 0.345. Take 100 minus 0.345. Okay, 99.655. Yeah. Okay. So now we got that number. So what we do, we incorporate this into this. Yeah. So we got 1. Okay. So survival rate year 1, we convert that into percentage, 100, 0.9950, right? Multiply by 0.99655. Okay? Then you get something, then you minus 1. Can one of you try to work it out? 0.9950 times 0.99655 minus 1. Will you get 0.850 or 0.000850? Managed to get it? Can I get it? Let me just see, huh? Oh, okay. I know where is the mistake. Okay, this one should be, we should use right to the dot, 99,493. Okay, round down, because I use 2 decimal places. We should use 3 decimal places. So this one, sorry about that, my mistake. Okay, it should be 0.99493. Yeah, okay. So in that case, if you take 0.99493 times 0.99655 minus 1, yeah, you should get 850. Yeah, right? You get that? Anyone managed to get the 850? Let me know, yes or no? Yes, thank you. Okay, the best way for an exam is to use 4 decimal places, up to 4 decimal places. Yeah, 4 decimal places. Okay, use 4 decimal. Now, so you managed to get it right. So this is how the cumulative default rate tables is being computed, right? So if you want to do for the cumulative default rate for year 3, you just multiply by the survival rate for year 3. That's it. I mean, survival rate 1, survival rate year 2, survival rate year 2. So you need to do that. Yeah. So this is how this thing works out. Okay. Right. So this is where. Hope you understand that. Right. Now, so let's go back to the practice question that Cleo Chong asked this morning. Right. He said, you want to look at this question. So this is the question, right? So he said, the probability of default for company A is constantly at 7%. What is the probability the company will default after year 3? So what this question actually says is, they want you to do the cumulative probability for year 3, right? They didn't tell you they want the cumulative probability. They just tell you what is the probability of the company will default after 3 years, means over a period of 3 years. Okay? Then you have to use the method that I showed you just now, right? So to explain this, you have the PD, which is the marginal PD, which the book says marginal PD, right? That's why I told you in exam, they don't use the word marginal PD, they don't use the word hazard rate, they don't use the word default intensity when it comes to all this computation. They just say probability of default. Means you must know they are referring to marginal default rate or default intensity or hazard rate. Yeah. Now, to be honest with you, in banking, we don't use hazard rate or default intensity a lot because those are mostly used in insurance industry. So in the banking industry, we tend to use marginal default rate or just default rate, yeah, the PD for that year. So in this case, the year 1, year 2, year 3, which is 7%, right? 7%, right? Okay, 7%. So if you want to calculate the cumulative probability of default for year 3, so this is the question they want, right? What is the for year 3, right? So all you need to do is you take 1 minus survival rate of year 1 times survival rate of year 2 times survival rate of year 3. Okay? So answer is very simple. In this case, since 7% is throughout the 3 years, you just take 1 times 0.93 times 0.93 and 0.93. Then you should get the answer. I believe is 19.6. Okay, so that's it. Very simple. Okay. Now this is not shown in your book. That's the problem. That's the problem. Yeah. And also, if you look at your mock exam, there's a question here. Okay. 49. Right, question 48. Same concept. They say triple B bond has the following default rate. Year 1, 5%, year 2, 7%. Calculate the cumulative PD on year 2. Right? Same. So what you need to do to answer this question, year 1, year 2, the PD is 5%, 7%. Then the cumulative PD, right, for year 2 will be 1 minus survival rate of year 1 times survival rate of year 2. That will be year 1 minus 0.95. That will be the answer. Right? I believe it's 16.15. Yeah, simple, right? So this is quite common in the exam. Yeah, so please make sure you do that. Okay? Thanks, Fazila. Thanks, Nurul, all this you guys help me out. Good. Right? So this is where, like I said, I want to explain to you because the book doesn't give you a guide on how to do this, and it's pretty confusing because they never explain those things clearly, right? So that's where a lot of people, I come to know about this when the other groups was telling me, hey, Mr. Ong, no, they tell me halfway and up to here, never explain that. So this is where I pick up, yeah? So that's a good thing that you all know about, right? So hope that you understand this, yeah? Okay? So anyway, so that is so-called the third table, right? On the cumulative PD, yeah? So understand how it works out. So there's a possibility that they will ask you from one, like in this case, within 1 year to another year, or throughout from 0 year to up to 4 years, right? Okay. And then they may also ask you using the PD to work out this question. Yeah, tricky. Must be careful when reading the question precisely, right? So sometimes you see when I tell you guys, you listen. That sounds easy, right? You understand. It sounds easy because you understand. But the thing is, if you don't practice some of the question, you may get all this stuck in the trick. So during the exam, you could be caught. So that's the best way is to do it, understand it, try it out in a question that will give you some good understanding. Yeah, all right. So I suspect this is one of those areas that you will find questions. Yeah. They emphasize a lot on these areas. Okay, right. So that is on the PD calculations or PD determinations using the external rating approach. Yeah. So remember, I told you the three tables: the rating tables, know how to interpret those tables. Then the credit transition metric tables, again, how to interpret it, then use it to calculate the first year and second year PD, right? Okay. And then the third table is the cumulative TPD, which I mentioned to you. Then try to understand what the cumulative PD table tell you, how to interpret it, and then how to use the annual PD, the yearly PD, to calculate the cumulative PD. Yeah. Okay. So that is something that you ought to know. All right. Now, one more thing before we break for lunch is that the other methods under actuarial methods, right? Okay, we have covered this part, right? We have done this. Okay. So now, what we look at the internal rating model, meaning that perhaps the bank themselves may want to use their own approach in finding out the chances of default, the PD chances of default. Yeah, right. The earlier one, external means we rely on third-party information to determine the PD, right? So next one is the internal one, and the one that's suggested in the book is the one using Ullman Z-score, right? Ullman Z-score. Remember just now earlier, I talked about, say, hey, Ullman Z-score, I will pass on, I will discuss with you later on, right? So that is the table same as what we're going to talk about here, right? It's the same thing, okay? All right, it's the same thing, right? So what it means is that another way to determine whether a company or a borrower, right, will default, what's the chances of default, is by looking at this Ullman Z-score. Now, this, what they show you here is the standard original Ullman Z-score. Okay, but in the market today, people has modified this Ullman Z-score, right, to meet their own requirement. They make some adjustment here and there. They change the ratio, right? They change the factor, change the weightage, just to suit their own requirement, right? So no harm about that. It's just a method used, right? So what you're going to learn is basically the standard original Z-score that was produced by Professor Ottman, right? So what is Z-score? This Z-score is basically a table, right? A computation, which will tell you whether a borrower will likely to be default or not, right? So if you do the computation and you come to the score below certain level, then the chances is this company have a chance of default. Basically over here they say, means if the outcome is less than 1, if the score is less than 1.8, then it is very high chance the company will go into default. Yeah? So the probability of default will be very high. How high? Depends. Your bank can set up your own scoring system, right, based on this score. 1.8, what is the chances? 1.6, what is the percent probability? 1.5, what is the probability? It's up to the bank to do it. But what we need to know here is just the general method of Ullman Z-score, right? So what is the Ullman Z-score? Ullman Z-score is basically an accounting-based concept. Accounting-based concept. Why accounting-based? Because they use accounting ratios. They use accounting ratios. Okay? Use accounting ratios. Yeah? So what are the ratios? Well, there are 5 ratios here. Remember just now when we talked about ratios earlier, we talked about liquidity ratio, right? We talked about the leverage ratio. We talked about activity ratio. We talked about the solvency ratios. The only thing we didn't talk about is the profit. But profit ratio is also there. The gross profit, net profit. So all the ratios are listed. So what it means is we look at all the 5 areas in terms of the company's liquidity, means how affordable are they able to settle their short-term debts? Profitable, how profitable is the company? Leverage, how much they have borrowed? Solvency, how can they afford to pay their debts? And activity, how well they perform, their performance. So each of these sector area we will look at it, and each of these factors are assigned a risk factor, right? So you can see here, the higher the risk factor means the higher the risk. So over here they say that, okay, looking at the leverage is a very, very important. Remember just now I said the interest, the what do you call that? The interest coverage ratio, right? The amount of profit that you make that can assign to pay off your interest. Remember that, right? EBIT, earnings before interest and tax. So they pay a lot of emphasis on that because it tells us how much money they can afford to use to service the loan, right? So because if you don't service the loan will go into default. So that's a very critical one, right? So that part is very high. That's why they put a very high factor there, right? So they put 3.3. Whereas in terms of solvency, means long-term ability to pay debts, less. Why? Because it's long-term, right? Too far ahead. It's important, but it's too far ahead. So it's important, but not so critical. That's why they put a lower risk. Okay. Now, in the examination, they may ask you to do the computation, right? But they will give you the factor. They will give you this factor, right? So you don't have to remember that. But you may have to look at this table and say, okay, by having a 3.3 factor means this is the most critical one, most heavily weighted one. Yeah. Okay. We also say, these are the areas that they look at. Means that companies' performance, liquidity, profit they look at. Yeah. Okay. And these are some of the ratios. Now, do you remember the ratios? Also, no need. They'll be given to you, right? So all these ratios be given to you. The factors will be given to you. So what you need to do then all you need to do is to know how to incorporate the number into the ratio and do the computation. That's it. Yeah. So if you look at your mock exam question given by AICB, this is something they will do. So they will give you, something like that. So this is a sample question, right? So they give you this, right? And then they'll tell you, you can see all these are the Almond Z score. So they give you the factor, and they will give you the ratios. So you just need to know what to put into the ratios. Okay, right? So like in this case, I actually work on it. So I just write up front, right? So you can work out the ratios, and then you can answer it. So most likely they'll tell you, okay, based on your computation, what is the final score? So if the final score is at this range, what this range means, that's the answer. That's the way that they do it, right? Very easy, straightforward. Yeah. Okay. But what I need you to do is to practice it, right? It's easy, but please practice it so that you know when you're given the number, you can do it fast. Like I told you yesterday or Monday, right? You practice it so that during the exam you can do it fast. Not to say that you cannot do. Even you don't practice, you still can do it if you understand it, but it will take a longer time. It will eat into your time. So it's better that you practice it and do it fast. Yeah. So this question won't be difficult. Okay. It will be very straightforward. Just to calculate. Yeah. Okay. So I won't go into detail then. So I leave it to you. Just work out. And most likely they'll ask you to come up with a score, and then what does the score mean? So they'll give you A, B, C, D. So once you know you got a score, you can determine the range. Very simple. Yeah, right? So we got an example here, which you can also refer to, right? And then you also have the example in the exam, the mock question, you can join it out. Yeah, right? Okay, but even though it's simple, but there are a couple of things I just want to highlight to you. What are the possible challenge that you may come across in the exam, right? Like I said, things are straightforward, but there are possibility that things might be a little bit tricky, yeah? So what can be the possibility, yeah? Okay, first of all, working capital, right? First is working capital. Now, actually, working capital does not appear on the financial statement. Okay? Doesn't appear on the financial statement. So there is a possibility that in the exam, they may not give you the working capital. They will give you the balance sheet. So, and the profit and loss account. Then you must know where to go and extract those information. Means they may not be doing something like so nice to you, put something like that for you, right? They could use, like in this case, they put working capital. But they could do a financial, for example, just now I mentioned financial statement, right? This financial statement. You may put a balance sheet there, and then ask you to go and find those numbers there, then and incorporate it, right? So if you look at this is the balance sheet, right? You won't be able to find the word working capital anywhere. There's no such thing as working capital in the P&L or the balance sheet, right? Okay. So where is the working capital? Now the working capital is current asset minus current liabilities. Now this one is current assets minus current liabilities, right? So it is possible. I'm not saying that it will definitely happen, but it is possible that they don't give you the working capital, but instead give you the balance sheet. Then you have to go and search for the number. And then how do you search for the working capital? You just take this current asset. This is like 45,000 minus the current liability 65,000. So like in this case, it's a negative working capital. Means 45,000 minus 65,000. So it's a negative 20,000. So the working capital is negative. Right? So this is one possibility that you may come across. Yeah? Right? Now I'm not saying that this will happen, but it can happen. So take note of it. Okay? That's one challenge. Another one could be total asset. Now remember I told you total asset. They may not give you total asset. Why? Because remember in the balance sheet, right? We have asset here. You have the capital or equity plus the liabilities or the debts, right? The borrowings, right? So sometimes they may not give you this number, right? But they give you this and this. So we know that in the balance sheet, this plus this is equal to the total asset, right? Add up here. So it's possible. So they may not give you a total asset, but they can give you the equity, capital, or liabilities. Then you must know how to add them together to get the figure. To get a figure. Yeah? Alright? Get a figure. Okay? That's the second one. And the last one that you may find it challenging is that you see over here, market value of equity. Now, what is this market value of equity? You look at the ratio. This ratio number 4, market value of equity. Right? Now, another question they can ask you is that, say, out of this 5 ratio, which ratio does not use total asset? You see, all the 1, 2, 3, 4, all the 5 ratio, 4 of them use total asset. Only 1 didn't use total asset. That is ratio number 4, X4. So sometimes they can ask you silly question like this. So you just take note of. But anyway, for this ratio 4, you use market value equity divided by book value of liabilities. Right? So book value, what is book value? Book value is in the financial statement. So this is the book value. Whatever appear on the financial statement is the book value. But how about market value? Market value. So market value doesn't appear in balance sheet. Market value is a value that is the share price. Market value of equity, right? Market value of equity is equal to the share price times number of shares, right? So in that sense, the balance sheet figure is a book value. It's not a market value. So in order to get a market value, you have to know the share price and the number of shares. So in the exam, sometimes they give you market value. Fine. But remember, what if the company is not a listed company? It's a private company. If it's a private company, if not even a private, Sendian Berhad lah. Sendian Berhad means the share is not traded on the stock market. So when the share is not traded on the stock market, means the share is not traded. When it's not traded, means there's no price. If there's no price, how are you going to calculate the market value? Right? So there's no market value. Or you don't have a reliable market value for Sendian Berhad. Okay? So this is where sometimes they may confuse you by talking about public company and private company. So this Orman Z-score is very suitable for public company. Yeah? Okay. Azrin, you're right. You can use CAPM, but if they don't give you enough information, you can't calculate. Yeah? You can't calculate, right? So if they give you, yes, you can do that. But if don't do that. So what happens is, if in the exam question, right, the case is on a Sendian Berhad, SD, right? If it's an SD, it is for SB, Sendian Berhad, they could give you both the market value of equity and the book value of equity. They can give you market value of equity, they can also give you book value of equity. Possible, right? In the exam. So what happened is, if the question involves a Sendian Berhad, and then they give you book value, market value. So the answer is this. Default a Sendian Berhad, you should always use the book value of equity. By default, you should always use book value of equity. Okay? But it is possible that in the question itself, they may say that even though this is a private company, please calculate using market value of equity. If that's the case, means they tell you to specifically use the market value, then you use market value. Okay? Right? Understand? Right? I repeat again. In an exam question, the case may concern a Sendian Berhad. Right? Now, if it's concern a Sendian Berhad, and if they give you the book value of equity and market value of equity, then by default, you should use book value of equity. Right? Unless there is a very clear instruction in the question saying that use market value of equity. Okay? Now, if they ask you to use, then you use market value of equity. Even though it's not correct, you follow what they tell you to do. Okay? That's what it means. Alright? Now, that's one scenario. Now, another scenario could be, it's a Sendian Berhad, but there's only one information given. Market value of equity. What do you do then? Just use the market value of equity. Yeah? Just use it. Right? If there's no other. So the only confusion comes is when they give you both of this. So which one would you use? That is the challenge. Yeah? So if they give you both, then if no instruction given, a Sendian Berhad should use book value of equity. But they can turn around and ask you to use book market value, so you just use market value. Okay? Right? So this is what can create the confusion. So I just let you know first. Make sure you take note of all this. Yeah? Okay. Now, one question from Alvin. You say that, can the ratio of X1 factor a negative number? Possible. If the working capital is negative, then the factor is negative. Yeah? So it means instead of add, you minus. Yeah? Instead of add, you minus. Right? Possible. Yeah? Right. So this is the challenge that you might face. Now, I'm not saying that you will definitely face, but it's possible, right? So just prepare you mentally, just in case you come across this type of challenges, you know how to deal with it. Means the less doubt you have, then the less time you spend figuring out so that you can do well in the exam. Yeah, right? But if those things are not it doesn't appear, if it's a straightforward case, then the question, then it is very easy for you to deal with this Orman Z-score. Huh? All right? Okay? So that is what I want you to take note of. So please practice those questions given to you, right? And also look at this example and try to understand it, and then work it out. Yeah? And take note of the 3 possible challenges I mentioned to you. Possibility of not giving you the working capital, you have to work it out yourself. Similarly, they may not give you the total asset, you must know how to work it out yourself. And the last one, the difference between the market value of equity and the book value of equity. Yeah. So for public company, market value of equity is always there, but for private companies, in practice, you may not be able to get the market value. So theoretically, we will use the book value. But if in the exam they give you both this, then you have to be very careful. If they don't say anything, you use the book value for student number I. But if they tell you to specifically use the market value, even though it's a student number I, then you use the market value. Okay? So those are the things that you need to think about. Yeah? Okay. That's it for this Omens Expo. Yeah? And also the actual approach to computing PD. Alright? Okay, done. So we deserve a lunch. Okay, sorry for taking up too much of your time. So now is 1:06. So probably I give you extra 5 minutes. So we come back at 2:05. 2:05. Okay. So 2:05 we will resume. So we resume. We go to the